All righty, let me just go ahead and click record here. Welcome everyone to this week's Sunday macro wrap-up for Sunday, June 29th, the last Sunday in June here, starting off with the second half of the year. We got the first week of July coming up. And as always, with the first week of the month, we always have labor market data, but there's also some other data, as well as some headlines that are going to happen on this short week, right? So we have Friday off for the 4th of July, so a short week, but pretty packed still. So we're going to get right into it here with some macro data updates, some different key events that are happening, as well as we're going to dive into some of the charts. For those who are joining us on stream on our TikTok, YouTube, as well as our Instagram page, the way that these Sunday macro wrap-ups work is that they're an hour long. The first 30 minutes is streamed online, and the last 30 minutes to 45 minutes is offline just for our Macro Optics members. And so if you'd like to join the discussion, for the second half of this, you can start your 7-day free trial by going to the link in my bio. For those on YouTube, it's in the description below. That's where we talk, different ideas, actually, actionable ideas from the stuff that we're talking about here in the first half. So there's that link there. All right. Well, getting into some of the different headlines this week. Obviously, this weekend was pretty, action-packed as well. Not as crazy as the previous weekend where, we thought World War III was going to happen. But we have a couple of different events coming up in July here. This isn't this week. This is actually the following week. But as you guys may or may not know, the 90-day tariff extension, that is coming up on July 9th. It could be a nothing burger, could not. We're going to see if there's a lot of trade deals that happen between now and then, because I think there's only a couple that are secured. Supposedly, one with China at the end of the last week happened, right? One of the tariff deals. And so obviously, the reason why the market has been celebrating in near all-time highs is because it thinks that a lot of the different macro risks are being reduced, right? So not only is the escalation in the Middle East, slowing down, but also too, which is great, by the way, but you also have as well that there could be a tariff resolution that happens that's not as bad as what the market previously thought. All different risks that the market is perceiving that are off the table, although the big risks are still not off the table. And we have a lot of macroeconomic factors that are still posing risks from now to the remainder of the year. With those risks in mind that we're about to get to, we always want to make sure that we're paying attention to our signal, which right now the S&P 500 is in bullish trend. You can take a look at the bookshelf in the background. The color is green. For those who are new to the channel, whatever color the background of of the bookshelf is, that's the trend of the S&P 500. So green's bullish, yellow's neutral, red is bearish. So we'll see what happens coming into this week here. Lots of different information. We also saw that Trump is blasting Jerome Powell, the current Fed chair of the Federal Reserve, that he's saying that Trump is, asking him to lower rates, right? He's been asking Powell to do this. Not only because, he wants to stir, some of the bottom 50% of growth, because really the bottom 50% of the United States has been in a recession for the past 3 years, whereas the top 10%, they've been in a boom, right? You have that K-shaped recovery in the economy. And so also as well, you have the huge debt wall, right? That's coming up over the next month or so, which, Trump said it here, they have to refinance $9 trillion between corporate as well as government debt this year. And if rates don't come down to, Trump said 1% goal, that could be a headwind that, could be coming later on in the next couple months here. That's, it doesn't seem like the bond market or the stock market has been, pricing any of that type of information in at all. So you got that on the back burner. Also as well, the tax bill, right? So the big, beautiful bill that Trump is trying to pass. That advances to the Senate, hopefully, or Trump is hoping that that gets to his bill. Obviously, that would also increase deficit spending by a lot, right? So there's estimates out there that are saying it would add, $3.3 trillion to the deficits over the next 10 years, which is a lot in deficits, right? This isn't the 3.3 trillion. That's not like debt levels, that's deficit levels, which remember there's a difference between debt and deficit, right? Deficit is the amount of money we have to borrow after we've already gotten money from taxes, and there's spending still left over that we have to that the government's obligated to spend, right? That's the deficit, which it looks like it's going to get blown out continuously, right? So from a government spending perspective, there has been zero difference between this current administration that was just elected in November versus the previous Biden administration. There has virtually been zero difference in terms of the fiscal dominance and fiscal just crazy spending. And you don't have to believe me, right? There's not only the numbers, but also two, when you take a look at the debt issuance, right? So if we look at here, this is the Treasury security issuance by the Treasury Department. And so as you can see in blue here, the Treasury has been continuing the Janet Yellen playbook with issuing short-term bills rather than long-term bonds. Scott Bessent, the current Treasury Secretary that took over for Janet Yellen, that's on the Trump team, he was critical of Janet Yellen for doing exactly what he's doing right now. This is going back to just continuous government spending, right? So again, you can look at the amount of proposed deficit spending in this new bill, as well as the amount of Treasury issuance, and you can come to a conclusion by just looking at the numbers that there is zero difference between the Biden administration and the Trump administration when it comes to spending, which means that for the deficit, it's going to continue to get blown out, and this debt problem is going to continue being a problem, right? The reason why Trump wants to lower rates is because that the amount of money that goes towards interest payments on the federal debt gets reduced. It doesn't solve anything. It's basically a ginormous Band-Aid, right? Another can kick, which is what the government does really well, and they've been doing it forever, pretty much since we've gotten off the gold standard in 1971. At some point, that's going to come to an apex where a lot of things will break, but we may not be at that point just yet. In the meantime, we can do our responsibility to our family with investing our money instead of just holding cash and letting it being eaten away by what the out-of-control government is doing. All right, taking a look at the actual hard data instead of just looking at headlines here. I always start with the least important information first, right? So let's get the headlines out of the way. Not that important. Let's take a look at the actual data. So over this past week, we had the GDP Fed Now. That continues lower, right? So the Atlanta Fed GDP Nowcast, you have to look at this as almost like a snapshot in the week of what the current indicators are showing, right? This isn't a future estimate. It's just showing what it's on track to do. So look at this like a trend, just like a price chart, right? So the estimates of GDP growth continue to slow, which is what we're seeing in the leading economic data as well, right? When you take a look at, I could actually just read off some of the numbers here, which we can also get into some of the data that we've been seeing this week. But when you take a look at specific data points such as the ISM Manufacturing New Orders Index, Manufacturing PMI, Services PMI, actually that improved for the ISM. But taking a look at the Philly Fed, Chicago Fed, Dallas Fed, New York Fed Services Climate Index, all these different things continue to decelerate. And so you're having a lot of leading economic indicators showing continued slowdown, while at the same time, you have a Fed that essentially admitted that they're going to wait until something breaks in total opposition of, what the government is wanting to do, right? So you have continued slowing growth. We're not seeing inflation accelerate too much, but we're seeing it remain sticky, right? The Cleveland Fed, they have a inflation nowcast, and they're showing that it's going to continue being at elevated levels, with core PCE remaining around 3%, right? So, like, inflation's not budging, It's kind of just staying where it's at right now, which is far from the Fed's 2% goal, right? So I know that, Trump keeps pressuring Powell to cut rates, but at the same time, Powell's looking at, this sticky inflation that's not near the 2% goal. He's also looking at leading inflation indicators, such as all those manufacturing indices. So Texas, New York, Philly Fed, um, as well as all of the NFIB, price hikes that have been going on. That continues to accelerate, right? So they're looking at that leading data and saying like, well, we can't really cut because inflation's still sticky. It's not trending down as fast as we would like. Remember, it's the rate of change that they pay attention to, not the actual nominal number. All right, and so we're still seeing that remain sticky. You don't even have to look at that type of stuff too either. You can just look at input prices, right? So this is the CRB commodity index, right? So this takes a look at the price of oil, natural gas, gasoline, gold, silver, copper, soybeans, wheat, coal, steel, not coal, lumber, iron, all those different inputs that are key for infrastructure and everything else that we use on a daily basis, right? Those prices remain, pretty elevated. If we go ahead and scroll back, you can really see that, commodity prices haven't been at these levels. Let me zoom in actually a little bit. I don't know if you guys can see this well, right? But you see the levels that we're at right here. It hasn't been, input prices haven't been this high since April of 2011, right? On an acceleration, well, April of 2011 as well as January of 2008, right? So definitely interesting at times in the market too, right? During those times. This is happening at the same time as, leading growth indices such as the Redbook retail sales index, right? So this continues, trending downward as well. If we just take a look back at this, pretty much since the middle of April, this has been trending downward to lower levels. So yeah, we've pretty much hammered that. Growth continues to slow. Inflation's remaining sticky, while at the same time, when you take a look at different, private liquidity, private banking restrictions, the banking sector is pretty loose, right? So they're pretty accommodative. And even Powell has said this in a lot of his press conferences, where there's ample liquidity in the markets, right? And that's part of the reason why you have the S&P 500 near all-time highs, because, just looking at these types of numbers here, there's no monetary crisis at all that's being priced in. And we don't see that in the data just yet. If this was spiking and accelerating higher like it was from October or November of 2021 to July of 2022 when the market bottomed during the 2022 bear market, then yeah, you could see that large drawdown that everyone's been thinking about happening for quite some time, but this still remains in a bearish trend, which is bullish for the markets, right? Let's see. The labor market. All right, so when taking a look at the labor market here, you can see, let me just zoom in here because it's easier to see. You can just tell that this is near the upper bound, right? So pretty much over the past 4 years since 2021, there's only been, let's see, really this is the third time that it's over that 240,000 initial claims mark. And so this is at an elevated levels for initial claims for unemployment, right? So obviously the labor market is pretty finicky right now, even though Jerome Powell gets on TV and says that it's solid when it's really not, right? You see all the videos of people struggling to get jobs right now. That's what's actually happening, right? And also too, we live in an environment right now where the gig economy has exploded, and it's actually more inconvenient to file for unemployment than it is to just sign up for Uber or, something like DoorDash, where you can just start making money right away and you get paid more by doing those types of, temporary gig services, right? So why would we, in this day and age, even look at initial claims? I don't know. The mainstream media is really obsessed with it. I think it could be a good indicator when this does start really accelerating on a year over year basis to pay attention to that, because that would mean that things are getting so bad that people are, filing for unemployment because they can't even do Uber or one of these gig economy jobs. So that would be pretty bad. All right, so we've been having a little bit of a rebound here in some of these other indicators, such as the S&P Global Manufacturing as well as Services PMI. Services actually continued to slow a little bit, but that was pretty interesting. I'm going back to data last week. Existing home sales showed a month-over-month increase, but when you look at year over year, it actually decreased by 0.7%. So, still, it's something where, let me see if they have a, no, I wanted to see if they had an overtime chart. Okay, yeah, here we go. Apologies, I'm bringing this this document up live. Okay, that's okay. So here's the percent change year over year for existing home sales, right? So there's a lot more existing homes in the United States than there is new homes, but there's actually a pretty dramatic acceleration from negative 2% year over year to negative 0.7. We'll see if that trend continues. Maybe it's in hopes of a Fed pivot. Who knows? Similar to what we saw back from October until January. This previous New Year. We'll see what happens there. Home pricing index for the S&P Global. That is continuing to slow. Whoops. All right, so housing price indices, not only for S&P Global, but same thing for the Federal Housing Finance Agency. That continues to slow too. Let's see here. Richmond Fed Manufacturing getting a little bit of an improvement. I'm just rattling off different data points. So if you have any questions, just leave them in the comments. U.S. consumer confidence continues to go down. This soft data really isn't something to look at in my view or my team's view as a leading indicator, but really just some type of lagging indicator. But I think it more so points towards the pessimism from the bottom 50%. So again, this just points to the K-shaped economy that's happening. New single-family homes continue to decelerate. Let's go over to the year-over-year mark. Yeah, so new single-family homes is still at a negative 6.3% year-over-year growth, right? So the new home sales has been decelerating. Manufacturers, durable goods, pretty large acceleration there. That was interesting. And then lastly, the core PCE did have a slight acceleration, right? So this is the Fed's preferred inflation gauge, by the way. And so as you can see with this, this 2.7% from where it's at, the average pre-pandemic was around like 1.5, 1.6%. Is 2.7% 1.6%? No, that's off by about, 100 basis points? That's pretty large. So what's going to get the Fed's preferred inflation gauge back down to where it was at pre-pandemic levels? Definitely not the amount of government spending that's happening right now, right? That's a key contributor. And so finally, going over to the price charts here, as we know, we had new S&P, new all-time highs. This is coming at the same time where the dollar is making new lows, right? You also have the yield curve. Let this load a little bit. You also have the yield curve having a bull steepening effect, which one of our macro optics community members sent me a quick message because I couldn't be here for the live call, but they asked that they asked a question about the yield curve, saying like, hey, we saw that the yield curve has been in a bullish steepening trend, which typically indicates economic recession or shrinking. But this is happening at the same time where we saw a golden cross in the NASDAQ, which is bullish. How do we make sense of that, please? Yeah, so you have to remember that the bond market is different from the stock market, right? And so, seeing that we're going from a flattening to a steepening, you have to look at it in the context of the reason why it's flipping, right? And so as of right now, it's not in the context of recession, but more of a context of a recovery, right? Which is a soft landing, right? So the bond market, as well as the stock market, is trying to price in a soft landing, going back to essentially where we were back in 2023, the end of 2023, and essentially all throughout 2024, right? And so, yeah, the bond market as well as the stock market, that's what they're trying to price in, which in my view, it's pretty bold because you still have, slowing growth happening. And if that continues to decelerate, then the Fed is going to continue to have an issue on their hands, right? And as of right now, for the July Fed meeting for July 30th, there's still an 82% chance that they're going to remain paused, right? And the first cut isn't being priced in until the September meeting, right? So there's no meeting in August. It actually skips a month. So it goes from July to September. And as of right now, there's a 76% chance that they're going to cut by just 25 basis points. So even if we're getting to all the way to the end of October, rates are still going to be near 4% to 4.25%, which is still pretty high and a lot higher than what the market was expecting at the beginning of the year. You have to remember that at the beginning of 2025, the market was pricing in 5 to 6 cuts. And that basically went from 5 to 6 cuts to just 2. And so we're in this cycle right now where, the market rallies and then, the wealth effect happens. People go out and spend, which in turn keeps inflation more sticky, which then causes the Fed to remain more hawkish, pushes out rate cut expectations. And because of that hawkishness, then people are like, oh man, we're not going to get our sugar high with, QE and all that stuff, which, might cause the stock market to sell off a little bit, which brings inflation down, which once the Fed sees that, then they start to get a little bit more dovish. And then the whole cycle happens again where because the Fed's getting a little bit more dovish in their rhetoric, the market rallies again. And we're just right back in that cycle. That cycle, it's kind of like a doom loop. That has been what's going on since 2013 or 2023, not 2013, 2023. And so, just because I call it a doom loop doesn't mean it's a doom loop, because the market has been performing pretty well in that environment. What happens is when that no landing type of scenario, becomes some type of landing, whether that's a soft or a hard landing, whatever the market is expecting, if it's better than expected, the stock prices can still go up. Even if you have a soft landing, if it's not as good as what's being thought, the market can still go down, right? So you always have to try and think about what the market is expecting versus what actually happens. Typically, the way that we do that is, the way that our process works here at Macro Optics is, yes, we look at the macro data, but really, all the data that comes out, the real hard data, that's actually looking backwards because it's typically on a 1 month lag. And then you look at the differences, or not the differences, but you compare and contrast the currency markets, stock market, and bond market together to see, what all those things are trying to price in, right? And so as of right now, both the bond market, currency markets, as well as the stock market is trying to, price in some type of soft landing where the Fed is going to start cutting soon, which is interesting, seeing that the hard data really isn't saying that just yet. So, we'll see what happens at the end of the day, though. Our model is still bullish on the S&P, and that's really what takes precedent here, right? So we can do all the math, we can take a look at the trends, we can nerd out on all this awesome information, but at the end of the day, we have to prioritize what the trend is doing, and that is currently in a bullish trend, and that's what we are going to respect here. All right, so you still have the volatility index of the S&P 500 below 17. We typically say that's a beach volleyball being held underwater. If that analogy, you can use your imagination on that. But also too, you have bond volatility very low, right? And so typically the market, when bond volatility is falling off like that, like we saw in the hard data with the private banking data, the in terms of private liquidity, there's not really any risk being priced in the credit markets at all, right? Gold has lost a little bit of trend. It remains bullish though. Bitcoin, same thing. And then that's pretty much it. S&P all-time highs. All right. Well, for those who are joining us on stream, if you guys appreciate this content, make sure you share it with a friend. Hit that like button. Also, too, if you want to join the discussion from now until the end of the hour here, we're going to be going offline with just our Macro Optics members. If you use the links that are in the bios and the descriptions, you can start your 7-day free trial of our macro investing community. But we're going to go and talk we're going to talk offline about ideas, but we appreciate your time. Have a great rest of your Sunday evening here, and we will catch you in next week's Sunday Macro Wrap Up. Bye, everyone.